Good morning and welcome to the Australian Early Finance Briefing for Tuesday, the 7th of July. I'm Nick Hurley. Today we're going to start with an update on the Virgin Airlines takeover saga. As we suggested in the show last week, the bondholders, the ones led by Temasek, the Singaporean Sovereign Wealth Fund, have submitted an application to the Australian Government Takeovers Panel, asking them to intervene in the deal Vaughan Strawbridge of Deloitte has made with Bain Capital. The panel has mentioned that the bondholders argue that certain circumstances regarding the process conducted by the administrators are unacceptable and block them from presenting an alternative deal to creditors at the second creditors meeting in August. So not terribly surprising there. It's an interesting situation. You could tell what Deloitte will say is that Virgin was literally going to run out of money by, I think it was now roughly like late June. It was literally down to the line. So they had to do a quick sale so they could keep going. I guess it depends whether the bondholders can successfully argue that they could have potentially stepped in at the same point as Bain did and provided the necessary operating capital to keep the airline going until sort of the finer details are ironed out. Okay, moving to the US, some interesting insights on the question about, is it going to be a U-shaped recovery or a V-shaped recovery from the coronavirus lockdown? This is in the context of the US, but I'm sure can be applied elsewhere. US Labor Secretary Eugene Scalia has said the economic recovery from the coronavirus pandemic has been better than expected so far, and it won't be necessary to extend an emergency unemployment program that ends this month. We are doing well. We do need to be careful about the virus, but I am just optimistic, he said in an interview on Fox News Sunday. Spending, retail spending, consumer spending generally, new home starts, all of these have been actually very encouraging economic indicators over the last 6 weeks or so. And yeah, that probably is true. There's been lots of economic measures that have shown a better than expected sort of recovery. That may be sort of curbed now with the re-implementation of lockdowns in some of the southern and western states of the US. However, it does sort of show that there is this sort of elasticity in the economy to recover quickly, and maybe the models of a slower recovery aren't quite right, just based on that last 6-month window. So yeah, something good to look at there. Goldman Sachs on that topic have come out with a report on Saturday saying that a combination of tighter state restrictions and voluntary social distancing is already having a noticeable impact on economic activity. Some US states have actually ruled out inside dining and those sorts of things. So obviously a huge employment impact there. They say that they now expect the economy to grow 25% in the third quarter, having previously predicted a 33% growth. That would result in the economy slumping 4.6% this year, which is worse than the 4.2% previously seen. But the Goldman economists did say they expect a growth of 5.8% next year, and now project unemployment will be at 9% at the end of this year, down from the previous estimate of 9.5%. So sort of mixed news there. Okay, moving to earnings and the lack of information in that. As you're probably aware, a lot of the rapid or huge gyrations, the high volatility in markets around the time of the emergence of the corona pandemic was driven largely due to an inability to sort of correctly price in future earnings. And it's still something that's largely unclear. So 80% of companies have refused to provide guidance over the last 3 months in the S&P 500 index, and that's the lowest on record, or the highest amount of refusing on record. And looking at analyst estimates, S&P 500 earnings over the next year are expected to fall from an average of $150 a share to $124.50, which is the fastest drop Bloomberg has going back to 1990. Another measure known as estimate dispersion, i.e. the sort of the range of different estimates in predictions for a share, the average stock is near record levels, which obviously is an indication of there's a large range of uncertainty and a lot of people really don't know. So one interesting point is that the aggregate sell side estimates for the S&P 500 companies, they expect profits to have declined by 44% in the 3 months ending in June, the quarter just gone, with earnings seeing double year-over-year declines in both the third and fourth quarters. But then they see a surge of 26% in 2021, which means it puts them back to not far off from the 2019 peak. So that, by implication, suggests that they're all pricing in a V-shaped recovery, that earnings will be back to where they were by next year, which is somewhat disturbing when we know that that's almost certainly not going to happen. And looking at the markets now, the US market opened about 18 minutes ago. The S&P's up 1.3%, with the Nasdaq up 1.9%. The Australian dollar is back almost at 70 US cents. It's currently at 69.7 US cents, which is roughly where it was back on the 18th of June. This is on the back of a big rally in China yesterday. The Shanghai index closed up 5.7%. The big rise in China was due to a front-page editorial on China's Securities Times newspaper, saying that fostering a healthy bull market after the pandemic is now more important to the economy than ever. In things coming up in Australia today, it's obviously that first Tuesday of the month, so the RBA will be coming out with a statement in the afternoon. And that is your Australian Early Finance briefing for Tuesday, the 7th of July. Have a lovely day.